Okay, let's unpack this. We are diving deep into Fiserv Inc. That's FISV, one of the absolute giants in the financial world.
A giant is right. They really operate at that critical intersection of, financial services and global commerce.
hmm
So if you use a credit card, check your bank balance, pay a small business, chances are you're touching Fiserv's infrastructure somewhere along the line.
But, and this is the core of our deep dive today, despite that massive scale, the company just went through a huge internal overhaul.
Yeah, the CEO called it a critical and necessary reset of their entire strategic direction.
So our mission today, and we're guided by a really sharp research report from Compasscope and the company's Q3 2025 earnings call,
Right.
is to understand why this reset was necessary. Why did they pull back on their financial guidance, and what does this new lower baseline mean for their long-term viability?
Well, the sources make it clear this is a classic high-stakes corporate transition. While the Q3 numbers look painful, and we'll definitely get to those, the core assets are still fundamentally strong.
So we have to separate the signal from the noise.
Exactly. Our first job is to distinguish between, say, temporary cyclical slowdowns,
Mm,
like the massive revenue bump they got from Argentina's high inflation,
okay.
and the more structural, self-inflicted wounds they sustained. Things like um, years of deferred investments and a management focus that was really just on short-term gains.
It really sounds like they're choosing to take some serious short-term pain now to build a healthier foundation for later.
That's the bet.
But before we get into the pain, we need to appreciate the sheer complexity of what they manage. I mean, Fiserv isn't just a single product, it's a vast machine.
It is. And to really analyze the opportunity and the risk here, we need to, structure that complexity. I think we can look at Fiserv through three main operational pillars, plus a layer of more forward-looking tech initiatives.
Okay, let's start with the deep plumbing, the backbone of traditional finance.
That would be Pillar 1, Banking and Financial Institution Solutions. This is the mission-critical tech that keeps banks running. It includes their core banking technology, which is, the foundational ledger system for a bank.
And what's critical here?
Well, the critical part is that Fiserv has been operating multiple legacy cores, something like 16 different platforms across their client base.
16. That sounds inefficient. A nightmare to maintain.
It is. So their big modernization effort, which
Mm.
is built around this modern cloud-native platform called FinTech, is all about consolidating those 16 down to just 5.
Consolidating 16 systems down to 5. That sounds less like a software project and more like changing the foundation of a skyscraper while people are still working on the top floors.
That is a perfect analogy for the risk involved, absolutely. And beyond the core banking, this pillar also covers issuer processing.
Helping banks manage credit and debit card accounts.
Yep, using modernized platforms like Vision Next. And then they have what they call banking surround offerings, digital tools like XD for better online banking or Cashflow Central for corporate cash management.
Okay, so that's the bank side. Now, moving to the merchant side, which is where we see more of their consumer-facing growth.
That's pillar number 2, merchant solutions. This covers your standard merchant acquiring services, kind of commoditized business of handling transactions.
But the real gem here is Clover, right?
The true gem is the Clover platform.
That's what you see on the countertop when you buy a coffee or get a haircut.
Precisely. It's that all-in-one point-of-sale solution that's just central to the small-medium business market, the SMB market. And Clover is massive. It's managing roughly $300 billion in annual gross payment volume.
Wow.
And for their bigger enterprise clients, they have Commerce Hub, which is their global omni-channel platform.
And the third operational piece, the digital highway itself.
That's digital payments and network services. This is more the clearing and settlement side. So they process Zelle transactions, manage the massive bulk of ACH transfers, and they run major debit networks like Star and Excel. This is the part of the business that provides that consistency and stability, really regardless of the economic cycle.
Okay, and finally, that crucial fourth area, the emerging tech and the internal operational cleanup. What's driving long-term change here?
Two big things stand out. First, they're pushing hard into embedded finance, leveraging those FinTech and Vision Next platforms to power other commerce platforms and neobanks. Second, they're attacking their own internal efficiency with something called Project Elevate. This is a multi-year AI-driven transformation initiative, and they've partnered with IBM.
And what's the goal?
The goal is to drive massive operational efficiencies across everything, sales, HR, client service, It's really the cost-saving, margin-boosting initiative that's supposed to help fund all these other expensive transformations.
That is a huge, sprawling portfolio, which brings us right to competition. I mean, with this level of scale and diversification, you'd think they'd have a strong competitive advantage.
And what's fascinating here, and CompassScope really highlights this, is that Fiserv does not possess the same deep technical moats of some of its more focused peers.
So no strong competitive advantage.
Not in the same way. Not like a firm built purely on, say, modern developer APIs might have. However, what they do have is immense resilience from the sheer breadth of their diversified business model.
Resilience is a nice word for stability, but where does the growth come from if they aren't the best-in-class tech stack across every single category?
Their edge is in their footprint and their high retention. They cover the entire financial value chain, both issuing and acquiring, which means they can aggressively cross-sell.
And once you're in their system,
It's sticky. Once a bank or a large merchant is on one of their core systems, the switching costs are just astronomical. That leads to extremely high client retention. And specifically in that SMB merchant space, Clover provides undeniable competitive differentiation. It's a very strong growth factor for them.
but the downside of being so diversified and, frankly, old is that you always have to fight the tide of modernization.
Absolutely. The long-term risks are acute. I mean, they face continuous competitive pressure in the merchant ecosystem from hyper-focused global players like Adyen and Stripe.
And internally.
More importantly, that massive 16-to-5 bank tech consolidation we just mentioned, that's not optional. That project is mandatory if they want to fend off new cloud-native players who just have lighter, cheaper solutions.
That expensive push for modernization directly explains where Fiserv is putting its capital, which brings us to their 5 key growth strategies. They're trying to play offense here to generate growth that can offset these reinvestment costs.
And they are betting heavily on these 5 areas. Number 1 is undoubtedly Clover expansion.
Taking it global.
Taking it global. Pushing into key markets like Japan and Brazil, targeting vertical market penetration, think healthcare, professional services, and expanding horizontally with software partnerships, like their integration with ADP.
And strategies 2 and 3 focus on those core enterprise and bank clients.
Correct. Second is Commerce Hub, aiming to build out a global unified omnichannel platform for their big enterprise clients. Third, banking transformation is that expensive internal overhaul we've been talking about.
Consolidating the 16 cores to 5.
Exactly, and rolling out those new modern surround offerings like XD.
And what about their bets on the future?
Fourth is emerging technology. This means ramping up adoption of embedded finance via platforms like FinTech and their investments in future areas like AI, that's Project Elevate and digital assets.
I saw they even acquired a company called Stonecastle.
They did, to secure a stablecoin custody license. It shows a very forward-looking posture.
And the final strategy is just about capital.
That's capital allocation. So disciplined, selective acquisitions that fit their strategy, like that custody license, and continuing consistent share repurchases to boost that post-2027 EPS.
If we connect this strategy to the bigger picture, is this diversified approach smart, or is it a sign that they're trying to be too many things to too many people? I mean, Adyen and Stripe are just laser focused on huge growth segments.
And that's a critical distinction to make. Pfizer's diversification offers higher consistency in long-term growth. Because if one segment slows, say, enterprise banking, Clover might be able to pick up the slack.
Whereas the focused players...
Contrast that with Adyen, which is purely enterprise omnichannel, or Stripe, which is developer-focused and highly tethered to the e-commerce market. Those focused players can achieve spectacular higher growth, but it's potentially far more volatile.
So Fiserv is basically sacrificing peak growth potential for foundational stability. But as that Q3 call showed, this whole transition is incredibly expensive. Short-term profit growth is stalled because they're funding this internal revolution.
Exactly. And that leads us to the biggest question of all, execution.
Right.
And here's where it gets really interesting, because Fiserv has deliberately chosen to undergo this massive strategic reset across multiple areas at the same time. They're not doing this sequentially.
They're essentially doing open heart surgery on their entire operating model while still trying to run the business 24/7. That sounds like a recipe for heightened execution risk.
It absolutely is. And CompassScope notes that Fiserv has heightened execution risks compared to some peers who might only be focusing on, one international expansion.
Yeah.
For Fiserv, four internal issues really stand out as potential showstoppers.
Let's start with the one that affects everything else.
First is the strategic reset risk itself. I mean, can management successfully implement this vision of one Fiserv, breaking down the internal silos, actually achieving the efficiencies from Project Elevate?
While keeping clients happy during huge system changes.
Yes, it's a culture shift as much as it is a technology shift.
And then there's just the sheer complexity of the tech work.
That's the second risk. Bank tech modernization. That consolidation of 16 legacy cores down to 5 is a massive capital-intensive undertaking. The risk of delays, cost overruns, and crucially, client attrition during these migrations is very, very high.
It's hard to imagine a more complex technical lift for a company this size.
I agree. Third, their biggest growth engine, Clover, is also facing some major logistical challenges.
This is the Clover scaling risk.
It is. They need to replicate their domestic success internationally in places like Japan and Brazil, where they're facing well-established, aggressive rivals like Square and, strong local players. The logistics and localization are huge barriers.
And finally, the race to establish a strong presence in the future of finance.
Right, the embedded finance adoption. Fiserv needs rapid uptake for their FinTech and Vision Next platforms by new digital partners. If that adoption is slow, they risk falling further behind first movers like Stripe, who already have a deeply entrenched developer community.
So the key context here is that while rivals like FIS and Global Payments have huge risks tied to, messy post-M&A integrations, Fiserv's primary risks are almost all internal.
They're entirely tied to the success of its own multifaceted transformation. It's their own choice.
Okay, let's pivot to that pivotal moment, the Q3 2025 earnings call. This is where the new leadership effectively scrapped all the old financial assumptions and detailed the reset. It was a major disappointment on the surface, but it sounds like a necessary cleansing for the future.
It was.
So what were the four factors that forced them to recalibrate expectations so dramatically for 2025 and 2026?
Well, the new CEO was very clear. They needed a realistic, achievable baseline. So factor one was purely cyclical, Argentina normalization.
Ah, right.
The high inflation and interest rates there had created this massive temporary growth driver for them. It contributed a remarkable 10 percentage points to their 2024 organic growth rate.
10 points.
Yeah. And that exceptional, unsustainable tailwind is slowing dramatically in 2025, which, it exposes the underlying core growth rate.
So they took out the cyclical noise. What was the second factor forcing the guidance reset?
It was really addressing over-optimism. Factor two was recalibrating optimistic assumptions. The original 2025 guidance was based on expectations for record sales activity and productivity improvements that management now admits would have been objectively difficult to achieve.
So they were guiding to aspirational numbers, not realistic ones.
That's what it sounds like. It's an accountability shift. And the third factor addresses the damage from the old ways of doing business.
Okay.
That was the impact of deferred investments. In the past, cost-cutting efforts had boosted short-term margins, but that came at the expense of crucial investments in client service, execution, and product development. They had built up significant technical debt that now requires immediate expensive repayment.
Just to meet client demands and launch products successfully.
Exactly. And the final piece of the reset was management actively eliminating activities that were just artificially boosting the quarter.
Ah.
Factor four was the deprioritization of short-term initiatives. Management is actively getting rid of revenue sources, including certain fee structures in Q4 that were designed only to hit in-quarter results rather than building long-term, high-quality recurring revenue.
This pivot immediately hurts the numbers, but it cleans up the quality of the revenue going forward.
Correct. It sets a cleaner baseline.
Let's look at the immediate financial snapshot from Q3 that resulted from all of this.
Well, the Q3 organic revenue growth was an anemic 1%. Yeah. And breaking that down really shows where the pain is. Merchant Solutions was up 5%, but Financial Solutions was down 3%.
And that 3% decline in Financial Solutions directly reflects the friction and difficulty of that core consolidation effort.
It has to. And as for Clover, their growth star, its gross payment volume, grew a reported 8%, or 11% if you exclude a gateway conversion. But the really important number is the outlook.
For 2026.
For 2026. The preliminary expectations now predict low single-digit organic revenue growth and modestly down adjusted EPS.
So that's the trough.
That is the trough. Management is guiding to what is effectively a painful zero-growth investment year as they absorb all these reinvestment costs and reverse the old short-term tactics.
But the prize waiting at the end of this tunnel is what they are targeting for 2027 and beyond.
It is. Post-2026, the company expects to return to mid-single-digit revenue growth and, more importantly, target that highly anticipated double-digit adjusted EPS growth starting in 2027.
And that is the whole long-term payoff.
It hinges entirely on achieving the operating leverage and the cost efficiencies promised by Project Elevate and that core consolidation.
So what does this all mean for you, the listener? If you are tracking this massive company going through this painful but necessary transformation, what are the most critical factors to monitor? What determines if they actually hit that 2027 double-digit EPS goal?
Well, the top 4 keys to watch identified by CompassScope are really all about execution, execution, execution.
Okay, number 1.
Number 1, and the most critical variable, is the execution of the strategic reset. Can management truly implement one Fiserv? Can they successfully consolidate those 16 cores to 5 and realize the promised efficiencies from Project Elevate?
Because if they misstep here, the entire long-term financial trajectory is jeopardized.
The whole thing. Number 2 is tied directly to the growth engine that needs to pull the most weight right now. Absolutely. The future growth of the Clover platform. They must succeed in executing that international expansion and penetrating key verticals like healthcare. If Clover starts losing market share to Square or Toast, the entire merchant growth narrative really falls apart.
What about the broader market dynamics? Are those a risk?
They are. That's number 3. Competition and pricing pressure in merchant acquiring. This whole segment is facing increasing commoditization. Fiserv needs to monitor margin pressure very closely because of intensified competition from Adyen, PayPal, and Stripe, who are constantly pushing pricing lower.
And finally, number 4, the bet on the future.
The success of embedded finance initiatives. We need to track the adoption rate of FinTech and Vision Next. Are e-commerce platforms and neobanks actually choosing to partner with Fiserv? If they fail to gain traction in this high-growth space, they'll limit their future total addressable market.
So to summarize the whole thing, the core thesis is that Fiserv is structurally sound. It's leveraging unique assets like Clover and FinTech. The current investment year, 2026, is going to be painful but necessary.
It's establishing a realistic baseline that clears away all that cyclical noise and, frankly, reverses the damage from past short-term decisions.
And the entire story really just hinges on successful execution of this modernization.
To unlock that highly anticipated double-digit EPS growth starting in 2027. This is the biggest corporate cleanup they've attempted in at least a decade.
And here's the provocative thought for you to consider. While Fiserv is focused on building high-quality structural revenue growth for the long haul, effectively setting the clock to 2027 will the competitive landscape, especially in those fast-moving, nimble areas like stablecoins and embedded finance, wait patiently for this multi-year, large-scale transformation to play out. That's the real test of whether this great reset comes fast enough.
Thanks for joining us for this deep dive into Fiserv's strategic reset.
We'll see you next time. This content is produced by CompassScope.com. For more than 1,100 public-listed companies, find detailed research reports, visual mind maps, earnings call analysis, and audio discussions on CompassScope.com.